So we got a problem on allocations related to book-to-tax disparities. So on January 1st of this year, Kiwi and Strawberry, as equal partners, they formed Fruit Sushi Limited Liability Partnership, a calendar year business, to create delicious fruit sushi. Kiwi contributed equipment of a fair market value of $100. So we know the problem is going to deal with book-to-tax disparities. So Kiwi's contributing equipment, fair market value $100, and Strawberry contributes $100 in cash. So they're 50-50 partners, both contributing $100 in stuff. One contributes cash. That person isn't going to be a contributing partner. That's going to be a non-contributing partner. And the other person is transferring property, which is going to have a built-in gain or built-in loss. Because if we have book tax disparities, it comes from that. Kiwi originally acquired this equipment 5 years ago in her sole proprietorship fruit packing business. The equipment had a recovery period of 10 years, and Kiwi elected to use straight-line depreciation. Kiwi and Strawberry agreed to share all profits and losses equally. The partnership will maintain the partners' capital accounts in accordance with Reg 1.704-1B2 little IV. That's going to be important because since we know that, we know it follows GAAP. So when we're doing our capital account analysis, we're going to apply GAAP principles for gains, losses, depreciation. It all reduces capital, right? The equipment would have a 10-year recovery period if the partnership had purchased the equipment this year. Each year, the partnership will have gross rental income of $20 before taking into account depreciation. The partnership will have no other income and no other expenses other than depreciation. So first, let's start with the traditional method. So let's assume the partnership agreement states, hey, under the traditional method, that's what the partnership is saying applies. How will the partnership allocate each year's depreciation on the equipment for book and tax purposes if Kiwi's basis in the equipment at the time of contribution was alternatively these differences, these different results? So $80, $50, and $20. So let's just go through and explain before we jump right into the traditional method, the steps. What's going on here? Again, you got Kiwi and Strawberry, two individuals joined together as limited partners. And Kiwi's contributing equipment, $100 fair market value. Strawberry contributes $100 in cash. Kiwi originally acquired it 5 years ago. So what does that mean? That means that 5 years ago, Kiwi has started, possibly, if they're sole proprietorship, if it's personal, it might be different, but Kiwi might have started depreciating it. Well, there's a special rule found in the regs for depreciation. We'll just say Reg 1.67, the 167 regulations, that says that the partnership comes in and steps into the shoes of the contributing partner in terms of depreciating. So what we're saying is, we're told, hey, if the equipment was purchased this year, it'd have a 10-year recovery period, straight line. However, it was purchased 5 years ago, so we're basically going to step into the shoes. The partnership's going to step into the shoes of the partner. So that means when the partnership gets this property, it only is going to take on 10 years. Because if you think about a timeline, right, we got years 1 through 10 of the life of the asset if it was new. So if the partnership bought it, it would have 10 years of straight line depreciation. However, it's getting it at the beginning of year 6, which we're going to call really year 1. So we got 1, 2, 3, 4, and 5. 5 years of depreciation. Does everyone see what's going on? So we're only taking 5 years, not 10 years of depreciation. So that means that whatever the tax basis is, we're going to divide that over 5 years because it's straight line. And we're going to allocate that accordance with how the partners, they split the respective items, which we're told they share everything equally. Now, in my class, for this topic, it will be very straightforward like this. It'll be a percentage or it'll be equal. It won't be like anything like crazy, like a special allocation or anything like that. I don't mix the modules. I don't mix substantial economic effect Reg 1.704-1 with Reg 1.704-3. I apply this separately. So the idea is that your profit loss ratios are going to be either equal or they're going to be some very clean percentage based on capital contribution like this. Okay? So that means we're going to take the amount, the tax basis, and recover that over the 5 years. Years 1 through 5 for the partnership. You all know that from other tax concepts, right? Cost, basis, principal. Also, what happens on formation? 721, partner and partnership have no gain or loss. Under section 722, the partner takes the basis of the item contributed, right? Under section 723, the partnership takes a carryover basis in the asset known as the inside basis, and that's important for these concepts. Going over to our respective traditional method problem that we're focusing on, the 3 independent situations, when the basis at the time of contribution is $80, $50, and $20, that's going to become the partnership's basis. And we know under this Reg 1.167, we step into the shoes, we're going to recover that basis going forward over the remaining 5 years, not 10 years. We step into the shoes as if the partner was themselves depreciating it over the time. So now we can go ahead and look at the rules for the traditional method. Here's the steps that we follow. We calculate the tax and book depreciation. And by the way, this is found in Reg 1.704-3B. We calculate the tax and book depreciation, and we're going to use the allocation ratios provided to us in the partnership agreement. Then we allocate book depreciation first. We allocate book depreciation first. And the reason why we do that is in another video, I showed you substantial economic effect. Start with section 704, distributive share, right? That's how you allocate items. The question is, will that be respected? If it's in the partnership agreement, it will be, but you also have to have substantial economic effect. Then we talked about how substantial economic effect is broken into 3 parts in the 704 regs. There's the normal substantial economic effect rules in Reg 1.704-1. There's the non-recourse deduction rules, and then there's the 704C pre-contribution gain or loss rules. So remember, we focused on how tax must match book. Tax must match book. That's what substantial economic effect focuses on. And that's why the capital accounting is so important. We're going to do capital accounting in this problem as well. For non-recourse deductions, we learned in another video that it's impossible for tax to follow book when the lender is the one that bears the economic risk. Now we're dealing with 704C pre-contribution gain or loss. You're going to see through these problems that it's impossible for book and tax to match. And the reason has to do with, okay, if we're buying an asset, if the partnership gets an asset with a fair market value of $100, the book amount is $100. But if the basis is $20, how do you allocate book depreciation? How does tax follow book when there's $20 of tax depreciation and $100 of book depreciation? Creates this disparity. We have to have special rules to allocate. Now, in keeping in mind with, okay, even if we can't follow book, we still will try to follow book as much as possible. So that's why the next step is to allocate book depreciation among the partners. We allocate book depreciation among the partners. So we do that before we look at any tax depreciation. We actually write that out. So we allocate the book depreciation. We're going to use a chart, and we're actually going to do that. We're actually going to put the tax depreciation on the chart. So you're going to see that's going to be the step. We're going to write that out. Then the third step is to consider the non-contributing partner. So in our example, in every single situation, because the facts all relate to the original example, the non-contributing partner here is the one that contributes the cash because there's no book-to-tax disparity. That's Strawberry. So we're just going to call these two taxpayers K and S. K is the contributing partner, and Strawberry is the NCP, the non-contributing partner. So anytime you see NCP, it's non-contributing partner. So step 3 of the traditional method is to first consider the non-contributing partner with respect to the assets that create the 704C disparity and match the non-contributing partner's tax depreciation with book depreciation. So you basically give them the amount that they allocated for book. So we go ahead and we put that in the chart for tax. we do the tax depreciation in the chart for the non-contributing partner. Then whatever's left over, any remaining, goes to the contributing partner in that order on the chart for tax purposes. All right, so let's go ahead and let's do this traditional method. We're going to do some steps. So first, we're told that the basis is $80. We got 80, 50, and 20. Those are all our alternatives. So let's go ahead. I'm just going to write those down. Let's do 80 up here. We'll do 50 over here. And then we'll do 20 right here. So if the basis, Kiwi's basis at the time of contribution to the partnership, which remember under section 723 becomes the partnership's basis, the partnership's inside basis in this asset. That's going to be what they can depreciate for tax purposes. Then we follow the steps. Step 1, we calculate tax and book depreciation. Well, for tax depreciation, we're going to take 80 divided by 5 years. There's 5 years of depreciation. Remember, we step into the shoes under the Reg 1.167. We step into the shoes. Kiwi had the property for 5 years. It would be 10 years if you bought it new. So the partnership is taking on is going to depreciate the remaining 5 years. So 80 divided by 5, what's that equal? 16. 16. All right. Now we're going to do the book. So the book, think about book, GAAP, generally accepted accounting principles, historical costs. When the partnership purchases or receives an asset, we use the fair market value at the day it's acquired, which is $100. The depreciation is also over 5 years as well. We use the same method. So for this approach, we're going to do the same thing for book purposes. Tax and book, the years are going to be identical. Same thing on the exam you're going to have. Homework, if you're taking another professor, you're going to do the same thing. Over 5 years, that's $20. $20. This is per year. So $16 of tax depreciation per year, 20 a book. Now, here's something that's really important. We're going to go to the book. We're going to break that out according to the ratio in the partnership agreement. Now, we're told specifically in this problem they share it 50-50, right? Profits and losses are allocated equally. So we're going to break that up between K and Strawberry each year, Kiwi and Strawberry, right? 50% of 20 is 10. 50% of 20 is 10. We're not going to do that with the tax. Do not do that with tax. Why? Because the rules. You're going to see the method that we use. Okay. So we just did step 1 for the 80. Let's do step 2 now. We allocate the book depreciation among the partners. So let's go to our chart. All right, I'm going to paste the chart, and let's go ahead and analyze this using our steps. Okay, so step 1 we just did, right? We calculated the amounts of tax and book depreciation, and we also had to break up the book based on the owners, Kiwi and Strawberry, using their ratios, using their respective ratios. So now, step 2 is to allocate the book depreciation among the partners. So before we go and we do that, we got to put their initial capital account balances. So S&P, the S, Kiwi, and the P is meant to be Strawberry. The key is Strawberry is the non-contributing partner, and Kiwi is the contributing partner. Okay. So the initial capital account balances are looking at when they contributed their money, right? Strawberry contributed cash, $100, so that's going to be $100, $100. Kiwi contributed property, equipment, with a $100 book amount and an $80 basis. So that is Kiwi's tax capital amount. For this problem, gross income, you would allocate out that $20 of rental income between them. I'm going to show you what you would do, right? We're told in the problem that they have $20 of gross rental income before taking into account the depreciation. So that would be shared 10 and 10. That's going to be important for the traditional method of curative allocations. We're going to put that in. So gross income is allocated 10 and 10, right? Because it's split 50-50. The depreciation, okay, so the depreciation, that's what we're doing here. That's what we're focusing on with these steps. We're told, step 2, allocate the book depreciation among the partners. So book depreciation is right here, 10 and 10. So we're going to subtract away for book, we're looking at the book amount, 10 and 10. That is step 2. Step 3 is first we consider the non-contributing partner, Strawberry. We give non-contributing partner Strawberry tax depreciation up to the amount of book depreciation. We've got 16 total tax depreciation. So we have enough to cover all 10. So we're going to give 10 to Strawberry. And then step 4, anything left over goes to the contributing partner, Kiwi, which here is 6 left over. So we give 6 to Kiwi. So if we calculate the amounts, at the end of year 1, this is 100, 100, and then for book, for Kiwi is 100, and then Kiwi tax is going to be what, 84? 84. You do that every year. You do that same exact calculation. I'm not going to do it with you every year, but you would do that same exact amount. And what would happen is Kiwi's amount would go from 84 to 88 to 92 to 96 to 100, and at the end of year 5, 100, 100, 100, 100. The idea is that the contributing partner has to bear that built-in gain over time. They're allocated that. So if the partnership was to sell it, it would go to that contributing partner. It keeps track of that. So as they go more and more in time and economic value is taken from the depreciation, guess what? It takes a little bit of the gain off. So you just follow that exact same format each year. The gross income would be 10, 10, 10, and 10, negative 6, negative 10, negative 10, negative 10. And again, when you get to year 5, it'd be 100, 100, 100, 100 as the end. Let's see what happens now if we do 50, applying the same steps. If we do 50, we take 50. We're doing step 1. 50 divided by 5 is 10 per year. If we do, that's tax. Book, we take 100 divided by 5, right? 5 years. 20 again. It's always 20, right? Book. It's always 20. So this is the traditional method. When we had 80, we're going to do below what it looks like when we have 50. Initial balances start off at 50, 100, 100, 100, right? Because now Kiwi is contributing the property. It has 50, 100, 100, 100. Gross income is 10, 10, 10, 10. That didn't change. It's still $20 of gross income split 50-50. The depreciation, we follow our rules. Okay, we do book depreciation, right? That's 20 and 20. It's 10 to each. 10 to each. So we're going to take 10 from book, 10 from book. The last step is to do tax depreciation. We've only got 10. Step 3 says, okay, give tax depreciation first to non-contributing partner to the extent of the book depreciation. Okay, so we give 10 to S. There's nothing to give to Kiwi. So you're going to get 100, 100, 100, and 60. So this would be the same each year. And it would go next year 70, 100, 100, 100, 80, 100, 100, 100, 90, 100, 100, 100, 100, 100, 100, 100. So at the end of year 5, it would balance out 100, 100, 100, 100. So we got one left to do for the traditional method, and that is, what if the tax basis is 20? So step 1 is to calculate the tax and book depreciation. So we're going to take 20 divided by 5 years equals $4 of tax depreciation per year for 5 years. For book, it's 100 per year. Sorry, my apologies. 100 over 5 years, $100 total, which is 20. And again, we follow our 50-50 ratio, so 10 to Kiwi, 10 to Strawberry. So we follow our rules. Let me erase Let's erase this one, the 80 one we did. So when the basis is 20, well, we have to start with our capital balances, right? 20, 100, 100, 100. The gross income is still 10, 10, 10, and 10. Depreciation. So we've done step one, right? Our step one was to calculate the tax and book depreciation. If we were to allocate it, calculate it out. Number two is allocate the book depreciation among the partners. So we give them each $10 of book depreciation. So far, it's been the same step for all three, right? That hasn't been different. Step three is to give the non-contributing partner up to the book amount of depreciation, tax depreciation. We've only got 4 tax depreciation. Uh-oh. We've only got 4. That's all we can give. Step 4, whatever's left, 0 to the non-contributing partner. This is called the ceiling rule. The ceiling rule means that, hey, you're limited to the amount of tax depreciation. You can't create tax depreciation. We can't do that. That's what the ceiling rule is. So the ceiling rule here comes into play whenever the adjusted basis of the property is below 50. Because when it was 80, we had enough to give even some to the contributing partner. When it was 50, we had just enough to give to the non-contributing partner, right? Because it was 10, there was nothing for the contributing partner. Now when you get below 50, there's not even enough to go to the non-contributing partner. This is called the ceiling rule. The traditional method, this is how it works out. There's nothing you can do. If you're on the traditional method, you have to follow this. So we would have 100. This would be what? 106. This would be 100. And this would be 30. So basically what happens here is over time, gain would actually be allocated to the non-contributing partner. Because think about it. Next year, you do this for all 5 years, the same amounts, all 5 years, if it's traditional method. So at the end of year 1, we have 30 for the in the tax amount. So it'll be 40 at the end of year 2, 50, 60, 70. For the non-contributing partner, it's going to be 106, 112, 118, 124, 130. What have we done? The ceiling amount, which is the difference between that 50 that we had in the previous example, which again is that $30 difference, is now going over to the non-contributing partner. Because look, the tax basis in the non-contributing partner goes up above 100 by 30 comparing to our previous situations, right? For example, when we had the 80 or the 50, the non-contributing partner always ended up with 100, 100, 100, 100, always. Year 1, 2, 3, 4, 5 are going to be 100. Now, it's going above 100, which means that the non-contributing partner over time is taking on $30 more of income. Yes, the basis goes up, but non-contributing partner doesn't want that. So what does that mean? When the non-contributing partner is negotiating the partnership agreement, they don't want the traditional method. They want either traditional method of curative allocations if they know there's going to be income, and we'll talk about that in a moment, or most likely, and you'll see this most likely in practice, the remedial method, because the remedial method would fix this issue. So what's happening is the contributing partner actually has $30 less of income over the 5 years, and the non-contributing partner has $30 more of income over the 5 years. So now let's move on to the traditional method with curative allocations. All right, so now we have our table, and we're going to go through this one faster because now that we've gone through the traditional method, you're going to see it's pretty quick to understand the traditional method of curative allocations. So we just went through the first part. We're now done with this. So you saw that application. Now we're going under the traditional method of curative allocations only if the basis is at $20. And of course I'm going to give you that because, hey, if it's $80 or $50, would there be any difference between the traditional method and the traditional method of curative allocations? No, it'd be the same because you have enough for the non-contributing partner. Only when it goes below will it make a difference because that ceiling rule is now what the issue is. So now we're doing the traditional method of curative allocations. How will the partnership allocate each year's depreciation on the equipment for book and tax purposes if the basis is $20? And then would the curative allocations affect the partner's 50-50 allocation of book items for purposes of 104-1B2 little IV? And how would the partnership allocate 20 years of gross rental income? And tax depreciation was what you're focusing on. So let's go ahead and go right to the steps. Now you go through the traditional method. It goes pretty quick. So we're going to calculate our tax and book depreciation again. That's our first step. Remember, our basis for this one is going to be 20. We're not going to have the different alternatives. So step one, we calculate tax and book. And it's going to be just like we did in the traditional method at 20. We've got 20 divided by 5 years. We've got $4 per year total depreciation, tax depreciation. For book, we have $100 over 5 years, $20 per year. So that's step one for book purposes. Remember also for book, we had the breakout. They share 50-50, so it's 10 for kiwi, 10 for strawberry for book purposes. Okay, now we go to step two. Step two, we allocate book. Kiwi, remember this is K and S, my apologies. This is K and S, right? K and S, my apologies. So their initial balances, 20, 100, 100, 100, right? Nothing different there. So we're not going to worry about the gross income yet because that's where you're going to see things are going to change. With the traditional method of curative allocations, that's where you see things are going to change, make a big difference. So rather than jump to gross income, I know it's the next line, we actually, when we have traditional method of curative allocations, we're actually going to skip that gross income line because I know we did that earlier, because under traditional method, you can't change that. If that's in the partnership agreement, you follow what's in the partnership agreement. So we go to the depreciation line. We're going to give book depreciation to the partners. So we give negative 10 depreciation, right? Or 10 of depreciation, 10 of depreciation. Okay, now we go to 3. First, consider the non-contributing partners' depreciation and give them as much tax depreciation up to the amount of book depreciation. So we're going to do that. We've only got 4, so we're going to give Strawberry, the non-contributing partner, $4. And then number 4 is allocate any remaining tax depreciation to the contributing partner here, Kiwi. That means there's nothing left to allocate. So far, steps 1 through 4 are identical. So the traditional method of curative allocations, these are now new. These are now the new approaches. These are now the new ones. So the next step is to calculate the subtotal and the capital account balances. And what I'm going to do here is I'm just going to make this a subtotal down here. The subtotal, it's going to be down here. The subtotal capital account balance, if we calculate the subtotals, we're going to get 20, 90, 96, and 90. In this gross income line up here, we're just going to cross that out because we're not going to put anything there. So ignore that. And then this depreciation down here, we're also going to ignore that as well because we've already done the depreciation, right? We've already done that step. So we just did step 5. All right, step 6. Allocate the book income of the corresponding income gain among the partners. Now, here's something that's really important to understand. You want to put this in your notes. It has to be the same character. It has to be the same character as the depreciation. So depreciation is ordinary character. So if you've got a long-term capital gain, section 1231, short-term capital gain, that's a different characterization. You can't use it. So if you have sale of stock and it's a capital asset, you can't use that $20 a gain. If that was in the problem, you would not be able to use it. But because rental income is ordinary income, we're able to match only character. It has to be the same character. You can't have differences in character. So because the book income is rental, and that's also ordinary, which is the same as the depreciation character, we are going to allocate book income, which remember is $20. Notice that we didn't break apart the 10 and 10 like we did earlier, of corresponding income gain among the partners. So what we're going to do is for book purposes, we're going to break that up, 10 and 10, because remember they're 50-50. So we are going to do that for book purposes, 10 and 10. Now what we do, we've just done step 6. Step 7, what we do is, in the book column, we're going to add together those amounts. By the way, crossed out that as well. I forgot to cross that out. We're going to add together the amounts. So we got 100 and 100. And by the way, in a perfect world, we want everything to be 100, 100, 100, 100. We know that's not possible because we have a disparity. But at least we want the non-contributing partner to be 100, 100 because economically, they, in the 704 rules, they didn't contribute that item. So 100, 100. So step 7, that's part of it. It also says first consider the non-contributing partner and allocate the tax income of the corresponding income gain in order to make the non-contributing partner equal the end of year book capital. So what I'm saying is, look, we've got 96 to 100. How much do we have to increase by to get to 100? 4. So we do 4 to get this to 100, boom. The remaining portion goes to the non-contributing partner, and that's step 8. So that brings us to 36. You do that same thing each year, and what's going to happen is it's going to go up by $16 each year. And if you take 16 times 5, you get 80. So you go from 20 to 100. So at the end of year 5, you'll have 100, 100, 100, 100. Now, a few things I want to note. Again, it has to be the same character as the depreciation. So if it's like a capital gain or 1231, nope. If it's ordinary income, it's good. Another thing is, if you don't have enough income to allocate, this method won't work out. So if we didn't have enough income to reallocate, is what I'm saying, it could affect this. Because there could be even bigger disparity. There could be even a bigger disparity, and then what would happen is it'd make this a lot different. But because we do have enough income of the same character, it actually ends up balancing out in the end. So this method is not foolproof. It doesn't always work. It doesn't always make it, but in this example, it did. At the end of year 5, it will be 100, 100, 100, 100. If you go through this same approach in each of the next 4 years. All right, so now we're doing the remedial method, and the remedial method is the most difficult, but it always works. Now, if you go back up to the facts, the remedial method, it tells us, okay, applying the remedial method, assume that the adjusted basis is going to be 20. So we're not going back to 80, we're not going back to 50, again, 20. So I told you and I explained how in the previous one, the traditional method of curative allocations, we might have a situation where it might not work out. Right? If we don't have the same income, we don't have enough, that could be an issue. And you would have the same disparity you had back under the traditional method without curative allocations. The remedial method always works. It's very important that we follow these steps for the remedial method. Now, this is an algebraic approach, but the way I explain it actually is more economical and shows you how things work out. So remember earlier, I drew out that timeline, right? We've got years 1 through 10. If the partnership was to buy the asset brand new, then the partnership would recover it over 10 years. That would not be an issue, right? If it's a 10-year life asset, that's what we're told in the facts, you recover it over 10 years, right? Year 2, 3, 4, 5, 6, 7, 8, 9, 10. And it'd be over 10 years. But we are really depreciating it over 5 years. So the remedial method, what it does is it basically, there's this hypothetical asset. The partnership basically is going to recover years 1 through 5, so year 1, 2, 3, 4, and 5, for tax purposes. And then for book purposes, it takes another aspect. It takes the remaining portion. For book purposes, it's assuming, hey, we bought a new asset. For tax purposes, though, we're limited by tax rules. We can't change the tax law, or else the whole tax system would crash. It's a legal system. We stick with our 5 years. So step 1, we break the pre-contribution gain or loss asset into 2 components. First, the original asset, as if the contributing partner kept the asset and continued depreciating it. And second, the additional value asset created by booking up the asset. The 2 assets will have different recovery period. Here's what we got. The $20, that portion, that's the tax portion, right? If we were, for book purposes though, we record $100, right, of depreciation. Or 100, over the 5 years. That was what we did in the previous examples. So what we're going to do is, for book purposes, we're going to say, we're going to do $100 over 10 years. Again, for tax purposes, we got a $20 asset, tax basis, that's all we can depreciate. For book purposes, we have a $100 asset. That's basically what we're doing. So we have to calculate the book portion of depreciation, the tax. The tax portion's easy, right? Again, it's just going to be the same as what we've been doing already. In the traditional method of curative allocations, it's all going to be the same. It's a 20 adjusted basis divided by 5 years, $4 per year. That's all we got. There's nothing more to that. That is still the same. This is what we do. We've got the year 1 through 5 portion for book, and then we have the year 6 through 10. Now, the 80 actually is recovered over the entire 10 years. It's a hypothetical asset, but if you were to buy an asset today that's $80 for book and tax, wouldn't you depreciate over 10 years total? You wouldn't say, oh yeah, for the first 5 years we're not going to depreciate it, and the last 5 years we will. You don't do that. So basically, when you're thinking of this $80 hypothetical amount, it's basically saying the hypothetical portion that's attributed to booking up. For years 1 through 10, total, you take 80, divide that by 10 years, that's $8 per year. Years 1 through 5 make up the other 20. That's only over because that's what the tax was, right? Over 5 years, that's 4. We break it up. 50-50, right? Book, tax, allocated 50-50, according to our partnership agreement. So 4 and 4, and this is 2 and 2. So what we're saying is that in years 1 through 10, looking at our chart again, we're going to take, each partner takes 4, and then years 1 through 5, they also get 2. So just the 4 for years 6 through 10. If you add all that up and multiply it by 2, you're going to get 100 total, because remember, we're doing book. This is calculating book. Tax is limited. Tax is limited to this amount right here. $4 of tax depreciation per year. You can't change that number. For book, it looks like this. Per partner. Per partner. All right? All right, so we've got our amounts, and that's the most important part. And again, we were calculating that per partner for book purposes. So we're saying years 1 through 5, it's 6, 6, 6, and 6, and 6. And then years 6 through 10, it's 4, 4, 4, 4, and 4. Okay, so years 1 through 5, they're going to have $6 of book depreciation, and years 6 through 10, they're going to have $4 each partner. So let's go through our steps. We just did step 1. Step 2 we just did as well, calculate tax and book depreciation using different recovery periods. So we broke up the asset, right? The $80 book up portion is over 10 years, and the $20 portion is over the first 5 years. Now we allocate the book depreciation among the partners, so we're going to do that. So in year 1, initial capital account balance, right? We've got kiwi and strawberry. It's 20, 100, 100, 100. So we take the 6, put under depreciation. And gross income, of course, is 10 and 10. That didn't change. It was $20, right, of total, and still allocated 50-50. Now the next step is allocated the book depreciation among the partners. Then we first consider the non-contributing partner with respect to the asset that creates a 704C disparity. So we're applying similar rules we had before. We have $4 of tax depreciation, but that's only in years 1 through 5. Remember, it's only in years 1 through 5. So we're going to give the non-contributing partner strawberry 4. There's none to give to kiwi. So we bring the subtotals down. The next step, allocate any remaining tax depreciation to contributing partner. We've done that. Right? There's none. We calculate the subtotal balances. So we bring those down. So we have 30. This is going to be 104. Thank you. This is 106. And then this is 104. So the next step is first consider the non-contributing partner and allocate a fictitious item of tax loss in order to make the non-contributing partner's end tax capital balance equal the end of year book balance. Note the character of the loss is the same as the pre-contribution. This is a fictitious amount. You don't need some type of offsetting income or loss out there like you do with the traditional method of curative allocations. You just need to create a fictitious amount. We know that depreciation creates ordinary income, so this is going to be ordinary loss. The character will be ordinary loss. So we go to strawberry and we say, hey, look, the subtotals don't match, 106 and 104. So what are we going to do? We want the end of year capital balance, we want that to be equal to the book. So tax follows book, just like we've been doing always for the deductions, substantial economic effect. So we need this 106 to be 104. So how do we do that? We give strawberry a $2 ordinary loss because it's the same character as the depreciation, and that brings it to 104. Now, to finish that off, we've got to allocate a corresponding amount of income because it's the remedial method. It's basically an offset. It's going to be ordinary income to Kiwi. It's going to be $2 of ordinary income, and that brings the amount 32, 104, 104, 104. So years 1 through 5, you will have that exact same process. At the end of year 5, the book, this should be 120, 120, 120, and this amount should be 80 if you do that each year, because 12 times 5 years will be 60, so 20 plus 60 is 80, and then 4 times, so the other items increase by 4 each year, and they'll go up to 120. So now we do years 6 through 10. So years 1 through 5 look exactly like year 1, like that. Obviously, capital balances at the end of the year change each year. They go up. But the same gross income allocation, the same depreciation, the same remedial allocation each year. So now we go year 6. Gross income is still the same, 10, 10, 10, 10. Right? $20 of income split 50-50, so 10 each. Now we go depreciation. So we go through the same steps. Remember, our book depreciation is $4 each in years 6 through 10. It's not 6. So following our steps, we're going to allocate the book depreciation to the partners. It's minus 4, minus 4. Then we're going to give, the next step is to give the non-contributing partner tax depreciation. Uh-oh, we don't have any. In years 1 through 5, it was wiped out. Tax depreciation's gone because we've taken $20 of tax depreciation over years 1 through 5. You can't just create tax depreciation. The asset's been fully depreciated. So there's no tax depreciation for either party. So we don't have anything to allocate. There's nothing to give to either party. Then we do the subtotals. So now we have 90, 126, 130, 126. So now we go back to our steps, number 7 and number 8. Consider the non-contributing partner. Non-contributing partner should balance out to 126, right? So now we need to go from 130 to 126. So how do we do that? We give -4 to the non-contributing partner. We have to give a remedial in step 8. We have to give a +4, same character as the depreciation, ordinary, to the contributing partner. So that's going to be 126, 126, 94. That's going to be the same for years 6 through 10. At the end of year 10, your balance should be 150, 150, 150, 150, and everything balances. So it shows you that the remedial method, it always works out. At the end, 150, 150, 150, 150, and that's what the remedial method does. If you have a proper allocation, at the end of the life of the asset, all 4 of these columns will balance. If you have a different amount, you've done it improperly. So remember, traditional method, when the ceiling rule does not apply, it will balance. Traditional method of curative allocations, when the ceiling rule or non-ceiling rule, non-ceiling rule, it'll balance if you have income to allocate. And then under the remedial method, it will always balance. Another thing to note is that in the end, the traditional method and traditional method of curative allocations, they equal out. But the traditional method remedial method does not equal out. Notice 150 versus 100. So it's different. All right, so again, this is going to be what you do through years 6 through 10. And years 1 through 5 all look the same. This is what it looks like at the end of year 10. You have 150, 150, 150, 150. You just do the same thing for those 5 years. Years 1 through 5, you do the same allocations of depreciation for book and tax purposes. Do the same for years 6 through 10, and you get those numbers. All right, so go back over these steps, especially paying attention to the remedial method, and review these. It helps tremendously.